There is a letter sitting in a kitchen drawer somewhere in Australia right now, half opened, pushed under the phone bill because the person who received it couldn't face reading it twice. It's from a lender, or it's from Centrelink, and it uses words like shortfall and review and your account. And the reason that letter frightens people over 60 more than any other piece of paper they own is simple. It's about the house, the one thing they thought was safe. And here is what almost nobody tells them before that letter arrives. By the time you open it, most of the choices that would have protected you are already behind you. Not because you did anything wrong, but because the letter always arrives too late to be the first time you hear about the rules. So today, we're going to open that letter early, together, while there's still time to do something about it. You've probably seen the headlines. Millions of Australians over 60 will lose their homes by 2027. Nobody's talking about it, and I want to be honest with you from the very first minute, because that's the only way this channel is worth your time. I can't tell you that millions of people will lose their homes. Nobody can. That's not a fact. It's a fear, dressed up as a prediction, and fear doesn't help you keep your house. What I can do is something far more useful. I can show you the actual mechanisms that put an older Australian's home at risk, and the actual tools written into the rules right now that are designed to stop that from happening. Because the truth is quieter than the headline and much more hopeful. You don't have to lose your home. Let me show you what the rules actually give you. Before we go any further, a quick note. This is general factual information, not financial product advice, not personal financial advice, not tax advice. It doesn't take your own situation into account. Before you act on anything, speak with a licensed financial advisor, a registered tax agent, or Services Australia about your own circumstances. The rules and the numbers change. Often each 1st of July, each 20th of March, each federal budget. So always verify the current figure at ato.gov.au or servicesaustralia.gov.au. I'll tell you exactly where to look as we go. After a career inside Australian finance, watching how the rule book lands on the family home, I can tell you the fear in that headline comes from something real, but it points you in the wrong direction. Your super fund won't ring you to explain any of this. Centrelink reads from a script. They process the form. They don't warn you. The rules that protect your home already exist, but nobody in that conversation has the job of sitting you down and reading them to you, in plain English, in time. That's the job I'm doing today. And stay with me right to the end, because the last thing I'll show you, the one about downsizing, is the one almost nobody gets right. And it's the one that quietly costs people the most. I'm not your financial advisor. I'm the person who reads the rulebook out loud, in plain English, so you know what to bring to your own appointment. Let's get into it. So let's start with where the fear actually comes from, because it isn't nothing. For most of the last few generations, the deal was simple. You paid off the house before you retired, and you walked into retirement owning it outright. That was the plan. But something has shifted, and I've watched it happen across account after account. More Australians are now carrying a home loan into their 60s than ever did before. Bigger mortgages, taken out later in life, sometimes helping the kids into a place of their own, sometimes just because prices climbed faster than wages ever did. So you arrive at 65 or 67 still making repayments, and then the paycheck stops. That's the real squeeze. Not a villain, not a conspiracy. Just a mortgage that was built for a working income meeting, a retirement income that's a fraction of the size. And here's what that actually means for you. If you're over 60 and still carrying a home loan, the risk to your home isn't some vague economic collapse the headlines are shouting about. The risk is specific, and it's personal. It's the gap between what your loan asks of you every month and what your retirement income can actually cover. That gap is the thing to look at, not the headline, the gap. Because the gap is something the rules can help you close. And I'm going to show you 3 ways they can. But before I do, let me clear away the single biggest fear people have, because it's usually built on a misunderstanding. And this next one catches even careful people. Here is the first thing I want you to hold on to, and it's the one that surprises people the most. Your home, the place you actually live in, your principal home, is exempt from the age pension assets test. Let me say that again slowly, because it changes everything. The value of the roof over your head does not count when Centrelink works out your age pension. You could be living in a home worth a great deal of money, and it does not reduce your pension by a single dollar because it's exempt. Now, why does that matter so much for the fear we started with? Because the story people tell themselves in the dark is, my home is worth so much. Surely the government will make me sell it. Surely it counts against me. And the answer, as at the 20th of March 2026, and please verify the current rules at servicesaustralia.gov.au, is no. The principal home is exempt from the assets test. What Centrelink actually tests is your other assets. Your savings, your super, your investments, your car, your contents, and there are limits there. As at the 20th of March 2026, a single homeowner can have up to around $321,500 in assessable assets and still receive the full age pension. For a homeowner couple, that combined figure is around $481,500. Above those limits, the pension doesn't vanish. It reduces gradually by $3 a fortnight for every $1,000 over the line. And it only cuts out entirely for a single homeowner once assessable assets reach around $722,000, or for a homeowner couple, around $1,085,000 combined. Those are the figures as at the 20th of March 2026. They move with indexation, so check the current ones at servicesaustralia.gov.au before you rely on them. Do you see what that means for your home? The house you live in sits outside all of that. It's protected. So the first tool in keeping your home is simply understanding that the home itself is not what the pension test is coming for. That single fact takes a lot of the terror out of that letter. And let me correct a myth right here, because it's one I hear constantly. People believe that if their savings are earning almost nothing in the bank, those savings can't affect their pension. That's not quite right. Alongside the assets test, there's an income test, and it uses something called deeming, which is Centrelink's way of assuming your financial assets earn a certain rate of return, whether they actually do or not. As at the 20th of March 2026, the deeming rates are 1.25% on the first slice of your financial assets and 3.25% above that. Verify the current rates at servicesaustralia.gov.au. Why does that matter to keeping your home? Because it's another reason the downsizing decision is more complicated than it looks. When you sell the home and the money lands in the bank or in super, it isn't only counted as an asset. It's also deemed to earn income under that income test. So the proceeds can touch your pension from two directions at once. Hold that thought, because it comes back when we get to downsizing. Now, let me be fair about something, because I don't want to hand you half a truth. That exemption is for the home you live in. If you move out permanently, or once we start talking about aged care, the rules around the home get more complicated and there are time frames involved. That's a conversation for a licensed advisor looking at your actual situation. But for the ordinary case, you, over 60, living in your own home, the home is exempt. Hold that, because it's the foundation everything else sits on. So the assets test isn't going to force you out. Good. But that doesn't pay the mortgage, does it? And you'll be thinking, but Oliver, understanding the pension is lovely, but I've still got a loan and a shrinking income. Fair point. So let's talk about the actual tool the government built for exactly this problem, and this is where the real help is. It's called the Home Equity Access Scheme, and most Australians over 60 have never heard of it, which is a genuine shame because it exists precisely so that people don't have to sell the home they love just to have enough to live on. Here's what it actually is, in plain English. It's a voluntary arrangement run by Services Australia, the same people who administer the age pension, that lets eligible older Australians borrow money against the equity in their home and receive it as a regular income stream on top of, or instead of, their pension. In other words, your home quietly helps pay for your retirement while you go on living in it. It's a government reverse mortgage, and because it's run by Services Australia rather than a private lender, the interest rate is set by the scheme. Let me put a real figure on it. For 2026, the interest rate on the Home Equity Access Scheme is 3.95% per year, and it compounds fortnightly. That's as at 2026. Verify the current rate at servicesaustralia.gov.au, because it does change. Now, I want to be completely honest about what that compounding means, because this is where I refuse to sugarcoat. The interest builds up on the amount you draw, fortnight after fortnight, and it's eventually repaid, usually from the sale of the home later on, often from your estate. So, this isn't free money. It's a debt against the house, and it grows over time. But, and this is the whole point, it's a tool that lets a cash-poor, home-rich retiree stay in their home and free up income, instead of being forced to sell under pressure the moment a letter arrives. For the right person, in the right situation, it's the difference between keeping the home and losing it. Don't take my word for any of this. It's on servicesaustralia.gov.au. Search for Home Equity Act, and it lays out who's eligible, how much you can draw, and how the repayment works. Whether it's right for you is a conversation for a licensed financial advisor who can look at your whole picture, your family, and your estate. I'm giving you the rule book, not a recommendation. But I'd rather you knew this scheme existed before you opened that letter than found out about it afterwards, when you'd already made a decision you couldn't undo. Now it gets more interesting, because there's a third path, and it's the one the headlines almost never mention. It's the one that feels like the obvious answer, and it's the one where people make the most expensive mistake. So stay with me, because this is the part I promised you at the start. Downsizing, selling the big family home, buying something smaller and easier to manage, and freeing up the difference. On the surface, it's the sensible thing. The kids have moved out, the garden's too much, the stairs are getting harder, and there's money locked up in a house that's bigger than you need. And the rules actually encourage it, up to a point. There's something called the downsizer contribution, and here's what it factually is. If you're aged 55 or over, you can contribute up to $300,000 per person. That's up to $600,000 for a couple, from the sale of a home you've owned for at least 10 years. And that was your main residence. You contribute it into your super, you have to do it within 90 days of settlement, and here's the appealing bit. It doesn't count towards your normal contribution caps, and there's no upper age limit on it. That's real, and it's set out at ato.gov.au and moneysmart.gov.au. Look up downsizer contribution and verify the current rules before acting. So far, so good. And you'll be thinking, well, Oliver, that sounds like exactly the answer. Sell the house, put the money into super, problem solved. And here, this is the trap. This is the one almost nobody sees coming, and it's why I saved it for last. Remember the very first tool we talked about? Your home is exempt from the age pension assets test. The home doesn't count. But the moment you sell that home and turn it into cash sitting in your bank or into a balance sitting in your super, that money is no longer your exempt home. It's now an assessable asset, and it counts. Every dollar of it. Do you see what just happened? You took something the pension test couldn't touch, the exempt family home, and you converted it into something the pension test counts in full. And if that pushes your assessable assets over those limits I gave you earlier, remember, around $321,000 for a single homeowner, around $481,000 for a couple, as at the 20th of March 2026, then your age pension can reduce by $3 a fortnight for every $1,000 over the line. So the very act of downsizing, done without understanding this, can quietly cut the pension you were relying on. You freed up money and lost income at the same time. That's the trap, not because downsizing is wrong, but because the home was invisible to the test and the cash isn't. And remember that deeming point from earlier. The proceeds don't just get counted as an asset, they also get deemed to earn income. 2 doors, 1 decision. I want to handle one more situation with real care, because it's the one that breaks my heart when it goes wrong. The survivor. When one partner passes away, the one left behind is often frightened into a fast decision about the family home. Sell quickly, move in with the kids, take whatever price comes. In the middle of grief, when they're least able to weigh it up. If that's you, or someone you love, hear this clearly. There is almost never a reason to make a permanent decision about the home in the first weeks. The home is still exempt. The tools we've talked about are still there. And Services Australia has that free financial information service I'll mention again shortly. Grief is not the moment to sign anything about the house. The rules will wait. Let them. Now let me be fair, because this cuts both ways, and I promised you the trade-offs in both directions. For some people, downsizing is absolutely the right call. If freeing up that money lets you clear a mortgage, or the income you lose in pension is smaller than the stress you shed, or you simply need a home you can manage safely as you age, then it can be exactly the right decision. I'm not telling you not to downsize. I'm telling you that downsizing has a pension consequence that the real estate brochure will never mention, and you need to run the numbers before you sign, not after. Whether it works in your favor depends entirely on your situation, and that, genuinely, is a conversation for a licensed financial advisor who can model it for you both ways. So let me pull all of this together, the way I'd want someone to do it for my own family. Because a recap is the thing worth screenshotting. If you're over 60 and frightened by that headline about losing your home, here is what's actually true. First, the home you live in is exempt from the age pension assets test, as at the 20th of March 2026. The house itself is not what the test is coming for, so verify that at servicesaustralia.gov.au and take a breath. Second, if the squeeze is income, not the house, the Home Equity Access Scheme run by Services Australia is the government's own tool to let you draw on your home's equity and keep living in it at 3.95% for 2026. It's a debt that grows, so understand it fully, but it exists so you don't have to sell under pressure. Third, if you're thinking about downsizing, the downsizer contribution lets people 55 and over put up to $300,000 each into super from a home owned 10 years or more within 90 days of settlement. But the proceeds become an assessable asset, which can reduce your pension because you've turned your exempt home into countable cash. Run that both ways before you decide. And here's the through line, the thing I most want you to keep. Every one of those is a tool, not a threat. The rulebook isn't trying to take your home. It's actually full of provisions designed to help you keep it. The tragedy in that letter in the kitchen drawer was never the rules. It was that nobody read them to the person out loud, in time. So now you've heard them. The exemption, the scheme, the downsizer trap, 3 things to check, and 1 number to call, Services Australia, before you make any move you can't undo. So here's what to actually do this week, in practical terms. If you're carrying a home loan into retirement, sit down and work out that gap I mentioned, what your loan asks of you against what your retirement income covers. Write it down. Then go to servicesaustralia.gov.au and read the pages on the Age Pension Assets Test and the Home Equity Access Scheme with your own eyes. Don't take my word for it. Check it yourself. That's exactly where the real detail lives. If you're weighing up a downsize, before you list the house, book a session with a licensed financial advisor and ask them one direct question. What happens to my age pension if I sell and put the money into super or the bank? Make them show you the numbers both ways. And if you're not sure where you stand at all, you can call Services Australia and ask about the Financial Information Service. It's a free service that gives you factual information about your options, and it exists for exactly this. And one last thing, because this is how we look after each other. If you know someone over 60 who's lying awake about the mortgage, or who's about to sell the family home in a hurry because a letter scared them, send them this. Not because I want the view, because the whole problem, the entire problem, is that people find these tools the day after the decision instead of the day before. You can be the person who gets there in time. That's the rule book. The home you live in is protected in ways most people never realize. There are tools built into the system to help you keep it. And a decision made in fear, in a hurry, is almost always worse than a decision made with the rules read out clearly first. So check it for yourself at servicesaustralia.gov.au, bring the real numbers to a licensed advisor, and don't let a headline or a letter make a permanent decision for you. I'll see you in the next one.